the Bank of Japan just hiked interest rates to a 31-year high. And, I mean, conventional risk models dictate that when rates go up, risk assets like Bitcoin go down. But instead, Bitcoin actually caught a bid and rose, which just shatters that reflexive, rates up, crypto down framework that so many digital asset managers are still running.
It does. And to put that timeline into scale for you, the last time Japanese rates were on this trajectory, digital assets didn't even exist. I mean, we're talking about an era before the modern internet was widely adopted.
Let alone decentralized cryptographic networks.
Exactly. It's the single most important anomaly in the markets this week. Because if you're deploying capital across digital assets, you're likely relying on risk models that have been conditioned by the last decade of United States Federal Reserve policy.
Where the standard allocator playbook says that when the cost of capital increases, speculative assets get crushed, which is exactly what we saw in 2022.
Right, but the Bank of Japan made their move, tightening the cheapest money supply in the global financial system, and Bitcoin did the exact opposite of what those old models predicted.
Okay, so I have to ask the obvious question that every allocator is staring at on their terminal right now. Why on earth did a central bank raising rates, which is traditionally pure kryptonite for crypto, cause Bitcoin to rally?
The plain English answer comes down to one massive mechanism: the yen carry-unwind. The carry trade is when investors borrow money in a currency with practically zero interest, like the Japanese yen, to buy higher-yielding assets elsewhere.
And just to establish the sheer scale here, how big is this trade?
We're talking trillions of dollars in global liquidity. It's roughly the size of the entire GDP of Germany just sloshing around the international financial system. Because for a generation, capital was practically free to borrow in Japan.
So institutional investors or, hedge funds would borrow yen for almost nothing, convert it to US dollars, and buy everything from US tech stocks to digital assets.
Right, pocketing the difference between the 0% they owed the BoJ and the 10 or 20% they made on risk assets. But as the Bank of Japan tightens and raises rates to that 31-year high, that USD to JPY dynamic fundamentally shifts.
Because the debt suddenly gets more expensive to service. The yen strengthens, meaning those managers need more dollars just to pay back the original yen they borrowed.
Yes. So capital that was heavily backed by borrowed yen is now rotating out. Managers are forced to unwind those positions. They have to sell assets to cover that increasingly expensive yen-denominated debt.
Wait, but that brings up my next dumb good question. If they're being forced to sell assets, why does that capital specifically seek out an asset like Bitcoin? Why not just retreat to traditional safe havens like U.S. Treasuries?
Because Japan remains one of the largest holders of U.S. Treasuries. When this specific fiat dynamic shifts, it moves billions of dollars across the board, looking for a new home that isn't tied to that currency pair.
So it's about finding an exit door that isn't connected to the burning building.
Precisely. U.S. Treasuries are heavily influenced by those same central bank policies. If you're a sophisticated allocator trying to escape fiat friction, you start looking for assets operating on a completely different physics engine. Bitcoin, being stateless with a fixed supply, offers a unique safe harbor.
Okay, let me try a physical analogy to make sure I'm wrapping my head around this mechanics-wise. Imagine you've held an incredible rent-controlled apartment for a decade, and that apartment represents borrowing that incredibly cheap yen.
I'm with you.
Because your rent is so artificially low, you have all this extra cash, and you use it to buy expensive art, which represents the risk assets.
Yeah.
You're living the dream. But suddenly, the landlord, the Bank of Japan, radically hikes the rent.
Right, the margin call.
Exactly. You can't afford the apartment anymore, and you have to move. But you don't just panic sell your art. You look for a secure storage unit that the landlord has no control over. Bitcoin acts as that alternative storage unit.
That is a perfect way to look at it. To lock this back to your context as an allocator, when the cost of the cheap capital goes up, the capital doesn't disappear. It rotates into assets insulated from that specific currency's new friction.
And we're seeing market structure changes that make this easier now, right? With onshore perpetual futures.
Yes, deep, regulated onshore derivative markets amplify the speed and scale at which that capital can rotate into Bitcoin. But, there is a counter-argument to all of this.
Well, yeah, let me steelman the strongest argument against this thesis. We are seeing broad-based selling and profit-taking across BTC, ETH, and SOL right now ahead of an expected Iran nuclear deal signing. How do you know this Bitcoin bid isn't just a short-duration geopolitical anomaly disguised as a macro trend?
That's a completely fair pushback. It's the exact question you should be asking your managers this week. Traders are absolutely treating the Iran deal as a binary risk event. And that event-driven profit-taking is creating short-term noise.
Because if a deal is signed, it fundamentally alters global oil expectations and emerging market risk sentiment.
Right. If managers are reducing gross exposure right now, it's rational hedging. But I will hold the line on the core thesis here. The Iran deal is a short-duration geopolitical catalyst. The Bank of Japan funding the global financial system is a structural macro reality.
So one is a weather event, and the other is climate change.
Exactly. This breaks if the BoJ immediately pauses its hiking cycle and USD/JPY completely stabilizes. But if they continue hiking, this is a multi-quarter macro tailwind currently underpriced by consensus.
Okay, so let's bring this down to brass tacks. The old playbook is broken. What do allocators actually do this week?
3 specific Monday moves to underwrite next quarter. Number 1, audit the risk models of the digital asset managers you allocate to. If they're modeling Bitcoin's correlation purely on U.S. rate cycles, they are running the wrong framework.
They're going to get blindsided.
Right. Number 2, monitor the USD/JPY cross explicitly as a leading indicator for digital asset flows. Historically, crypto managers ignored foreign exchange markets, but today you cannot understand Bitcoin's price action without watching the yen.
Got it. And the third?
Number 3, look at the current event-driven profit-taking from the Iran deal, uncertainty not as a structural weakness, but as a tactical re-entry window to deploy dry powder before the macro tailwind takes full effect.
Okay, if you remember nothing else, here's the whole thing in 3 sentences. The Bank of Japan raised rates to a 31-year high, and Bitcoin went up instead of down. This matters because it exposes the old rates up, crypto down risk framework as dangerously outdated for sophisticated allocators. When the landlord finally raises the rent on the cheapest money in the world, the capital rotates into a vault they don't control.
Nailed it. Here's what this can't tell you yet. Exactly how much of the global yen carry trade has actually unwound versus how much is still heavily indebted and waiting for the next shoe to drop.
And the real thing we're watching is whether this new correlation holds when the U.S. Federal Reserve makes its next move.
That's your AION Investor briefing. Stay informed every weekday. Subscribe now and download the AION app at aionpowerhouse.com.